The inflation number for the month of November just came out, was published by Bureau of Labor Statistics. The CPI inflation for the month of November has increased by 0.1%. Yearly, it is increased to 3.1%. Earlier in the month of October, it was no change. In September, it had gone up 0.4%. The core CPI, which is X the food and energy, for the month of November, the CPI gone up 0.3%. Yearly annualized for the year 4.0%. Earlier in the month of October, it was 0.2%. In September, it was 0.3%. So the core inflation, which is more important because the food and energy is not included, which is very volatile, is still very high. Other components, I will go one by one how it has been tracking for the month of November. Food at home, it has gone up 0.2%. Food away from home up 0.1%. Energy is up 0.4%, yearly 5.3%. Energies and commodity, it's dropped 2.3%. Gasoline has been down quite a bit, minus 5.8%, down 5.8%. For the year, it has dropped significantly, minus 9.8%. For the month of October also, it was down 4.9%. In September, it was up 2.3%. Energy services, it's up 1.7%. Again, other important things to notice is the new vehicles. The vehicles CPI, the inflation has gone down by 0.1%, yearly 1.3%. But surprisingly, the old vehicle, used car vehicles and trucks price for the month of November has gone up by 1.6%, although yearly it has dropped minus 3.8%. Earlier from the month of October, it was down minus 8%. In the month of September, it was down big amount by minus 2.5%. The shelter component is still nagging, it's staying high. The shelter for the month of November is 0.4%, yearly 6.5%. So this, the increase in shelter was offset by the gasoline price in the core CPI calculation. And even for the month of October, it was up 0.3% and up 0.6% for the month of September. However, the shelter components are actually, it's a lagging indicator. So because all these like the contracts for the house sales, they will also be included in this CPI numbers. The medical services, then other services, the service without the energy is still high, 0.5%. So we are a very service-based economy here in the US. So the yearly services inflation is 5.5%. So in this background, tomorrow the FOMC meeting is continuing today and tomorrow. Chairman Jerome Powell, he is going to be speaking. I think last time he spoke about that what the economic outlook, whether he's going to be dovish or he's going to be very hawkish. And there is, as you see in the CME tracker website, the inflation, the Fed rate is at 5.33% as of December 8th. So according to the CME tracker, tomorrow's meeting, there is no the expectation, the probability that the rate will remain same at 98.4%, meaning only 1.6% of the people, they think that they're going to be increasing any hike in the rates. meaning the rates are going to the Fed rates short rate is expected to remain same. For the month of January, there's 94% chance the rate will remain same. There is a 4.1% that rate can drop by quarter points. For the month of March, however, there is 40% chance that Fed is going to cut rates by quarter basis points. From 5.5%, it will drop to 5.25%, and there's 42% probability, and 55.4% will remain same, and very negligible number 0.9% they think the rates are going to go up by another 25 basis points. And for the month of May, it is almost 50%, 49.7%. The rates are the Fed is going to cut rates by 25 basis points, and 24.1% of the people think the rates are going to remain the same, and 24.8%, about 25% people think the rates are going to drop by 50 basis points. So 25% thinks that the rates are going to drop by 50 basis points. About 49.7% thinks the rates are going to drop by 25 basis points. And another quarter remains that they think the rates are going to same, the high rates at 5.5%. So there is a wide dispersion, how much the rates are going to be dropping. So there are basically like the Fed has been raising rates very high, almost from 0 to 5.5%, sometimes 25 basis points, sometimes 50 basis points, sometimes even 75 basis points, and at a very high rates, and then they slowed it down a little bit to 50 basis points, 25 basis points, and they have been holding it steady. So what is, I think, from the market is telling is that the rates are going to remain same for some time, and maybe earlier in the first quarter, end of March, or in May, the Fed is going to cut rates. So sometimes in the middle of the rates, we can hope the rates are going to drop, but it's not going to drop by earlier where the rates used to be very low, 0%. So it will drop by, I think the overall expectation is around 2.5% to 1.5% rate cuts next year in 2024. So some of those like the loans, people who are taking car loans, mortgages, other kind of vehicle loans, or other the departmental store, credit card, etc. So some of the rates they are correlated, so they're going to drop a little bit. But however, you cannot expect that it's going to be how things used to be 3 years ago, where the rates were really low. The unemployment scenario is pretty good. I think the unemployment numbers currently stands at about 3.7% for the month of November. So the economy, the people are gainfully employed. The unemployment numbers are very low since COVID. The unemployment number went up very high, almost to 20%, and since then the unemployment numbers are coming down, hovering around almost the lowest number in last 2 years to 3.7%. And the wage inflation has been, the services component has been around 5%, and Federal Reserve Chairman Powell said that he has the target of 2% inflation rates. So there's a long way to go. So certainly it is not expected that he's going to be cutting the rates tomorrow. However, he might give some indication that he might do some data driven kind of a decision in the next 1 or 2 months. But overall, according to the market expectation, the rates are going to be coming down because the inflation is coming down in certain sectors, and even the shelter components should be coming down in next 1 or 2 months. And the bond market is also indicating currently the 10-year treasury rates is at 4.2%. There is not a lot of movement. It dropped only by 0.5 basis points. The 1 month rate is 5.39%. 30-year rate is 4.3%. The 2 month rate is pretty important. It's 5.43%. These are today's bond yield rates. So if the Fed cuts rates to like say 50 basis points, the currently the yield curve is inverted yield curve, so it's going to kind of like revert. It'll the short end of the curve is going to be pretty close to the 10-year rates. So that's what's it will be very interesting to know what Chairman Powell talks tomorrow. Let's keep our finger crossed. Hopefully you like this video and found it informative. If you liked it, please do subscribe it. I would appreciate it. Thank you very much and have a nice day.